Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
Hello, this is Josh McCown from Renault Winery Resort, and we have a very important announcement from Matt Sorensen about Learn and Grow, August 24th. Take it away, Matt.
I'm Matt Sorensen from Directed IRA. I'm excited to be the keynote speaker at the Learn and Grow event for Accountable Equity on August 23rd and 24th. You've got to book your tickets and get registered. I'm excited to be there and to meet you in person.
Here's the one.
I have a dream.
With great power comes great responsibility.
I can do this all day.
This is it. Don't get scared now.
They may take our life, but they'll never take our freedom.
Cinderella story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Welcome back to the big show, John. Thanks for coming.
Yeah, absolutely, Josh. It was awesome interviewing Borko Milosev. He is from Serbia originally.
Yeah, he is.
Immigrated in the late 90s. And,
Yeah, I mean,
wow.
His company, folks, is called Post Road Management. Listen, it's always a kick in the pants when you meet great people who get the privilege of being immigrants to this country that we take so for granted, and they just take $700 in a suitcase, that's what he said, and become controlling partner of 16,000 apartment doors over the course of 20-some years. So what a story. And he did it differently than most of our friends, right? I mean, he built it, in a sense, he reverse engineered his Wall Street days.
Yeah. You'll learn how Borko went from being an investment banker in New York to owning a massive real estate portfolio. And he walks us right through it.
Yeah, I thought it was great. Borko's going to inspire most of us on this call, if not all of us. So I think you're going to enjoy this episode.
Let's go.
John, thank you so much for putting together another incredible show for us with Borko today.
Yes, and we've been trying to get Borko here on our show for a little bit. And Borko, it's great to have you. Can you please give our listeners a little background on who you are?
Great to be here. Thanks for having me, guys. So I'm a real estate owner operator that at the moment have about 4,000 apartment units. At one point had about 14,000 apartment units that we asset managed. 140 employees, father of 3, sports lunatic. We can get into what that all means. Love to travel.
Go ahead. Tell us the name of the company and where it's based out of, Borko.
Sure. So it's called Post Road Management, and we are based out of Bethlehem, Pennsylvania, Lehigh Valley.
You know, I mean, Borko, we rarely have people on the show that say, I used to have 14,000. Now I just have 4,000. That's amazing. But, you know, you have a slight accent. You must be from Kentucky.
That's right. No, I'm from Serbia. I immigrated in 1999. I came here basically by myself to pursue better life. So I came as an exchange student in high school.
Oh my God!
College, had a great luck to meet another Moravian alum who gave me an opportunity to intern for him and then eventually work for him in New York City. I did real estate investment banking and worked and lived in New York for about 10 years. And, the gentleman that I gave this chance is still a good friend and a partner.
You know, John, I know this is the first time we've done one of these shows where there's right off the bat, okay, we have to break it down because so many of the entrepreneurs that have been on the show, John, about Borko, they've done it a little bit differently than what I think you did it. So you're saying you were in New York City as a real estate investment banker. I think that's what you said.
That's right.
Which then allowed you to see behind the curtain, like Wizard of Oz a little bit. And you learned how to buy these apartments.
Yep.
But you bought a lot of apartments. Were you super rich or something? How did you get started with this many apartments?
So there's two things I guess you brought up there. One is kind of seeing behind the curtain. So I really started seeing behind the curtain very early on, even during my internship. So I worked for a bank. Then we financed real estate deals, and it was deals that were $50 million and above. And this was again, 2004. So, 20 years ago. And people that borrow 50 million and above are fairly affluent and, a lot of them well-known real estate kind of individuals. So as a young, 20-year-old, I was very impressionate and was like, holy moly, right? This is sort of what I want to do. And so my eyes has been on that prize, ever since, if you will. So since from when I went back after the internship, I went back to school, I started researching and reading a lot about real estate. And that's, it kind of piqued my interest enough where I really shifted my focus from initially I wanted to kind of do like a Wall Street stock trading, stock investing type of thing. But it's changed my view completely. And so I actually bought my first home that senior year while I was in college. And we can talk about that. And it kind of maybe ties into your second question is I was wealthy, and it's quite the opposite. I think I came with a suitcase and believe about $700 to this country. The way I made my first money was anecdotal. Happy to get into it if you want. But basically, I had a couple of bucks saved as a savings bank that went public, and they offered me IPO shares. And and also as a student, not a lot of money, didn't know what to do with it. I went to my finance professor and asked her what to do. She says, buy as many shares as you can. So I was able to scrape about 10 grand to buy these 1,000 shares of this a company that was going IPO. And after it debuted on a stock exchange, I made 7 grand and thought, biggest kid ever. Sold, the stocks, paid back the 10 grand that I borrowed. I had $7,000, which was the money that I needed to basically buy first FHA home with like no money down. So that's kind of how I started. Bought a first FHA home, had no money down, used the $7,000 and, for improvements. I was able to refinance it and pull a bunch of money out, $20,000, tax-free, as you know, and reinvest it into a second home and a third and so on. And then at one point, ended up, going back to New York, got a job for the investment bank where I interned, met some interesting people, and one of my MDs basically was my first equity partner. So he lent me part of the equity to buy a first multifamily deal, a 16 unit here in Bethlehem in 2005.
Yeah, what a shift, because when you're in Wall Street or when you're in Manhattan or whatever, you're doing 50 million and up, I think you said.
Yes.
But you were able to translate like the pattern down to 16.
Right.
Which is actually, for those listening, that's actually kind of surprising, because most of the time when you're buying 50 million up, it's so structured. It's got management in place. We're talking about apartments, large scale apartment buildings and things like that. But what is the difference then? So how did you overlay that and buy a 16 unit? Because even that is surprising.
Yeah. So to your point, it's been same strategy ever since. We've just been kind of replicating our model of buying assets that we feel are undervalued and creating value, through various various ways, whether it's through capital improvements, whether it's through better management and things like that, and then either refinancing or selling those assets. But as you pointed out, it's a one single formula that has worked for us for the past 20 years.
Whatever question Josh just asked, it sounds super interesting. The internet has never gone out of any show that we've done, and it went out. And I was getting ready to ask you how you scaled 14,000 units, and I'm guessing, is that what you just asked, Josh?
No.
Okay,
No,
let's
go
there.
Yeah. So I've been buying kind of one-offs, and aggregating slowly that way. I'll also tell you our goal and our desire it wasn't, and it still isn't, ever to be the biggest. We always say we don't want to be the biggest. We want to be just most profitable. So we will buy opportunistic deals, we'll work them, we'll create value, and then we'll exit. So we buy and sell. We don't accumulate necessarily. It's just that in the past, we've been buying more than we've been selling, and that's why our size has grown. As far as 14,000 units, that's a little bit of an anomaly. In 2015, I was with a New York City family office. It's a developer that buys and owns a lot in New York, Miami, LA, things like that. Had an opportunity to buy a distressed portfolio of suburban multifamily apartment buildings, which is my core competency. And I've already had a relationship with that family. They invested in a couple of my deals, so they asked me actually to go and work for them. And I refused to do that because I already had a viable business. But what I offered was, let's partner up and I'll be your operating partner and I'll run it. And, I'm an hour and a half to New York. Whenever you need me, I'll be there. So we bought our first first portfolio in 2015. It was 5,500 units in 5 states. We owned and operated that for about 6 years. We actually sold it in 2021 and did fairly well.
Yeah, I bet you did.
North of 30% IRR.
Yeah.
And then because that was doing well, in 2019, we got an opportunity to buy another distressed portfolio of 8,500 apartment units, which is now in the process of disposing.
Yeah. Forgive me. Go back. What year did you buy the distressed portfolio?
So first one was 2015.
15. That's a surprising year for distress. I would have thought you'd say maybe like 2010 and then maybe recently.
This was a very interesting story. A gentleman bought a portfolio, I believe it was 2013, and 2 years later, or maybe it was 2012, and then 2 years later, refinanced and pulled like hundreds of millions of dollars. 5,500 units was part of a much larger portfolio. There was about 20,000 units. Gentleman cash out refi almost $250 million through CMBS debt. And clearly was a mistake because, as you pointed out, in 2015, they went belly up. The portfolio defaulted, and we ended up buying up portion.
Wow. And did your partner, so I'm guessing you didn't syndicate because you said your partner has a family office and they were wealthy. Did they finance that whole deal, or did you go in for half?
Yeah, so 2015 deal, there was the debt was actually in place. It was a CMBS loan that went into receivership. We were able to negotiate with the current lender to stay in place, but restructure the loan, sort of to create there was too much debt. So they carved out that debt into A tranche and B tranche, and subordinated some of that B tranche to our new equity. The family office put all the money, and I essentially had a profit participation with them. So I acted as an operating partner with a profit kick.
I'll tell you, Borko, you're talking some high-level stuff here, and I'm excited to learn from you. But so here we are. We don't get to meet you in person today. We're doing this over the internet, of course. And I'm really attracted to the fact that you were able to build such a big business from $700 in a suitcase to what you are today.
Thank you.
With 140 employees. But how about the children? How old are the children, and what's family life like for you at the Milosev family?
Yeah, so I have 2 kids, 4 and 2, and third one on the way.
Oh, good for you.
Thank you. I have 2 girls and a boy. I love being a father. I love being a husband. I'm definitely a family guy. Hate to admit it publicly, but I guess I'll do it, that I haven't really been coming back to the office since COVID. That's, I think, how much I enjoy a family life and, being able to have breakfast with them. With that said, I'm on the road. I kind of say that half jokingly, but, I'll wake up. I take the morning shift, let the wife sleep, spend time with kids, have breakfast with them. I see them off to school, and then I'm off doing my work. And then after this with you guys, I'll go home, probably hang out with them for a bit, and then finish work into the evening.
And is work mostly visiting your properties, or are you out on the hunt to find more? What's work look like today for you?
Really more of looking for new projects.
What will make okay, now we have to ask you, the economist, Borko, the intelligent gentleman. How are you going to find deals right now when every other friend of ours, John will tell you, they're either saying it's impossible to buy a deal because of debt, or, what's going to make you better than all the other people?
Yeah,
I'd love to hear your ideas.
Josh, and I'll be lying to you if I told you that I don't have second thoughts almost every other day as to why I'm doing this. Was to your point, most of the people are sort of taking a sabbatical, enjoying their life, enjoying families, and again, I've don't mean to boost, but like I've done well, right? I'm well ahead of what I've set, what my long-term plans were, but I don't idle well, so I'm keep looking. My betting average is definitely down, but with that said, I am looking at least at a couple opportunities. If we talk on Wednesday or Thursday, I might be reporting to you that I've been selected to buy an opportunity from not-for-profit.
Okay.
Yeah, so there's some kind of odd deals that I'm looking out there. One is that I'm trying to buy something from a not-for-profit. They're disposing of a small portfolio of assets. There's another project out Midwest. It's a low-income housing tax credit deal that's exiting its restriction period.
Yes.
So looking at it, it's a very low cap rate basis, right? But there's an opportunity to grow rental rate fairly quickly because you're turning tenants now to market. There is a 90-unit vacant project in also Midwest where it was an insurance issue that they had a freeze at the building. It flooded. They got paid out a bunch of insurance monies. Kind of the guys abandoned the project. So it's a very hairy with a lot of heavy lifting. So there's these atypical deals, not your typical stuff that I would see. And again, my betting average is horrible, but I'm not giving up. I'm still stepping up to the plate and swinging the bat, and one of them will hit.
Yeah, John, I mean, having young kids and doing what you're doing, it is challenging. And how is your wife doing with raising the young kids while you're out? And you said you have some flexibility, which is fantastic. COVID kind of definitely helped a lot of families in that respect, being able to work remotely. But how's your wife handling it? That's my first question. And my second, is your wife involved at all in your business?
My wife is not involved, which she's focusing sort of on the kids and the family. And as far as she's been very supportive. I've spoken to her on numerous occasions, frequently actually bring it up to make sure that we are kind of checking in with each other, making sure that even though we're not working at it together, that we're aligned in our pursuits. And she's given me thumbs up. One advice that I've gotten from the gentleman that I mentioned to you guys that gave me the internship and then a job is sort of my equity partner is his advice was when I started having kids is hire as much help as you can, and that has played a pretty that has worked out well. Just because not all the burden is then on wife in terms of keeping the house clean and taking kids and where they need to go and cooking a meal and stuff like that. So fortunate that I can do that and alleviate some of that from her, because I recognize that she needs to have a life, outside of just, caring for the kids.
No, absolutely. And now that we're coming to the end here, I'd love for you to teach us a little more. It seems like you by the way, great job, John. And if you want to, John, you can always just jump on me. But I will say, would you mind teaching us a little more? Because a lot of the people we have on the show are similar to me. I have a private equity group that we are a community of investors. And then we go out and buy properties with syndication and create small funds. It sounds like your model is very different. So how does the model work when you don't use syndication, Borko? Can you describe a capital structure for your deals?
So I do have partners on bigger projects. I was lucky that I've while I was in New York, I made some good relationships. I had met some good people that have now followed me for the last 10 plus years, right? So there's a handful of them, maybe 3, if you will, that come to all the deals where I need to syndicate parts of the equity. Besides that, the rest of it is pretty, keeping it simple, stupid, if you will. We'll borrow first mortgage to whatever we borrow, 70, 75%. Back in the day, it was 80%. And then the balance of the equity is, pass the hat between me and those 2 or 3 other individuals. And it's sort of simple as that. With that said, I'm starting to recognize the need and desire to potentially broaden that. So similar to you, your model is I'm starting to talk to other groups and broaden that base of investors for 2 reasons. One is, not all investors have same risk tolerance or appetite for deals. And number two is, as wealthy as these guys might be, I don't believe they have unlimited pockets. So I also recognize that at some point I might hit my ceilings. Now, one thing that I've done well with them is that I'm fairly quick because I focus on opportunistic deals. I'm fairly good at recycling that capital and giving it back to them, whether it's through sale or refinancing. So, they might be feeling they're playing with the house's money at this point, and are more open to kind of reinvesting with me.
Yeah, that makes a lot of sense. I mean, closing the loop on investors, getting their money back, getting them profits. Of course, they're going to want to turn around and keep, putting more in and play with the house money. Absolutely.
Yep.
One thing I'm trying to understand is Bethlehem, Pennsylvania. Now I know there's been a song. Who sang that song?
Bruce Springsteen.
Bruce Springsteen. Yeah.
Or Allentown, right?
He named it Allentown, but he actually was singing about Bethlehem, I believe.
Bethlehem Steel. That's right.
Yeah. So, but how did you pick Bethlehem? And it seems like you're staying in that area. Tell us why.
Hi, this is Melanie McCallan. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com. You can fill out the contact form. We'll get right back to you and see if this is a great fit for you and your family. We'd love to meet you. We look forward to learning about you. Please visit us at accountableequity.com.
Hey, this is Matt Sorensen, author of the Self-Directed IRA Handbook, CEO at Directed IRA. You're listening to the best podcast, the Capital Hacking Podcast.
Yeah, so I didn't pick it, John. I know you're religious, so am I. I think it was maybe God's plan.
There you go.
So look, I got picked. So when I came to study abroad as an exchange student, I got picked by a family. It was a host family, and they happened to be technically not in Bethlehem. They were in Easton, but just one town over.
Yeah.
And as I finished my high school and really wanted to stay in America, I enrolled to a local college, now university, called Moravian University, which is in Bethlehem. So it was sort of the only place that I knew. And again, I got randomly or by some greater design, picked to land here. And look, I do think it was God's will, because through Moravian is, how I met the gentleman that gave me the internship, and then the job is now investor and my partner, capital partner on most of my bigger deals. Now, as far as moving, it's a good question, one that I often talk to my wife about, and I don't know that we have a definitive. There is so we'll see where we end up.
Well, and a follow-up question on this, but feel free to share. You talk a lot about how you're in the business of value add for the multifamily world, and you do sell them, which is a very valuable strategy. Now, how do you guys protect? Let's talk about this in two ways. Why is that better? And I'm not saying, let's just do a defense of your strategy. Why is it better to do it the way you do it rather than build a portfolio, refinance, and hold?
Right. That's a good question. So I thought of it a lot, and I actually just started. I study math, right? So I like to look at the numbers, and we just started kind of building it out, and I'm happy to. And we proved it out that it is better, and I'll tell you why. So when you buy a value add project, right, if you're looking at it on a continuum of time, right, then let's say that it's a 5-year or 10-year, whatever the whole horizon is. During the period of time where you're doing the value add work is where you're going to create most of the value. So let's say that the value add work takes you a year or 2 or 3, it doesn't matter. Most of the value you're going to create is during those periods of time where you're doing that value add work, whether it's renovations, improvements, whatever it is, cutting expenses, rising revenues, rising rents, whatever it is. After that period of time, if you've done all the work, how is the value of the property going to change? The only way the value of the property is going to change is generally inflationary, or something happens in the market that you don't control, right? Like people decide to move to Miami because, right, they don't want to live in New York City anymore, right? And you have a compression of cap rates. But those things I don't control, nor do I generally as an investor buy or invest that way. I always say I have a bad way of predicting trends. I try to buy, what's in place and try to create value that I can see today, right? Rents are $800. I know I can raise them to $1,000 when I go renovate bathrooms and kitchens, right? As simple as that. I don't complicate it to try to think what's going to happen to Nashville in 3 years, right? I don't know, right? Or I don't spend time trying to figure out what's going to happen. So again, if you look at it, if you look at the IRR over a 5 or a 10-year, the rate of return over that period of time, and you break it up and looking into segments, again, most of it is going to be compressed. So my question back to you is then, if I know that, right, if I created most of my highest part of the rate of return in the early years, and the rest of them is kind of inflationary or whatever market driven, then after I'm done, why wouldn't I sell in a perfect world? If I could sell it and do the same over again, it's the fastest way for me to compound, right?
Wow.
Now, if I refinance it, I get my money back, but you still have 20% of your equity tied in. So now that 20% of equity is going to grow at some, let's say, inflationary level, versus if I found another opportunistic deal, I could grow it instead of 3-5%, I can grow it maybe at 20%. And
you make a good point.
Then the question comes of taxes, right? What about taxes?
That's exactly
right?
where I was going.
And again, after this, I'm happy to share with you, it's not a super complex, it's a rudimentary, but we looked at 3 scenarios. We say buy and hold for 10 years, buy, sell after 5 years, reinvest, pay taxes, reinvest, or do it every 3 years, assuming in a perfect world that you can constantly find opportunistic deals, which is a big assumption, right? You can't. Like we talked earlier, right? There's market conditions that don't allow you, and then you might be better off holding versus sitting on your cash that generates no return. So it's not a perfect world, but again, if you could, you would be better off even if you pay tax. I never understood, and like for us, we'll do 1031 if we can find a good deal, but we won't do a 1031 into a deal that has, subpar and what would be considered subpar, right? I won't do it at 10 or 12 or 15% rate of return. It's just, I feel like I'm tying up my money. Now, I will also say one thing. All that we're doing is a lot of work, right? And it's kind of like, I joke, it's a young man's game. As I maybe want to like kick it back a little bit, right? And relax and enjoy life a little better and smell the roses, that strategy might change because it's certainly more hectic, involves, again, much more work. But I'm convinced that it's a way to grow capital faster than any other way.
Well, I mean, it's similar to the people in the single family business where they flip in order to generate some cash, but usually they say so that they can build a portfolio once they have some cash. But we suffice it to say, I do think you make a lot of great points that if you could generate as much of your IRR quickly through that value add strategy, then isn't it better to redeploy into a new deal, generate that again? I think so. I would love to see your spreadsheet because if you pay that tax, though, that tax that you absorb, you feel like that is that's a thief. That's a thief of your power, your equity. This is the argument I sometimes question. John and I have a group called Go Abundance. He's a big tribe leader of that, but they have you keep track. Yeah, I'm in it too. We keep track of your personal financial statement. And this is the crazy part about a personal financial statement. If you have a $100,000 house and it goes up by $150,000, you pull out the money you put into it, the $50,000. You get to keep it on your balance sheet as whatever balance of equity. Then you put the full 50, whatever the profit was, right, into another house, and you get to count that equity too. Whereas if in the middle there you would have maxed out, taken some tax, and bought another one, you'd have this like crater in your net worth for a period of time. Whereas if you get my point.
Yeah.
It's an interesting thing. Once the IRS takes it, that at least for a period of time, it feels like you gave up some net worth.
Yeah.
And it's an interesting connection. I've been trying to work with.
Clarify that, when you brought up single family homes, right? When you are flipping those, you're generally paying more in income tax, which is very bad, right? Versus, capital gains tax, you're paying probably about half, right? Which you would if you were flipping within a year. So even if you bought a smaller building and we turn it around within a year, we would probably wait and only pay capital.
Right.
And again, to your point, if I can defer taxes, we wouldn't, try to do a 1031. There's a lot of strategies there. Even one of our Abundance members, I think, talked about some interesting strategies through these DSTs and things like that. So there's ways to do it. We also employ for new deals, right? We're employing cost strategies. So we are trying to manage that tax. But kind of a big picture, I'm still convinced that if you can reinvest it at 25-30% IRR type of a deal versus holding it and just kind of riding it out, I think you will grow your capital base faster, even with paying capital gains tax.
Very interesting. Borko, thank you for bringing so much wisdom. Where can our listeners connect with you if they want to connect and also ask further questions?
Sure. So I'll give you my email my email, if that's all right, it's Borko Milosev at postroad MGMT, POST, ROMD, MGMT.com. And then I'm trying to think if my Instagram handle is at Milosev Borko or at Borko Milosev, but Google me that way, it will pop up. Sorry, I don't know at the top of my mind.
We'll put the Post Road Management URL in the notes as well. It's been great getting to know you, buddy. Can't wait to see you in person.
Thanks for having me.
Awesome. Thanks, Borko.
See you guys.
Damn straight. We just got we got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.